5 example video for Accounting 2. So in Chapter 5, we're looking at CVP analysis. We're going to run through this example. This is the integrated example at the end of Chapter 5 if you want to look at it in your textbook. So our first question is, what is the contribution margin per unit? Well, we can see that the total contribution margin is $8,000 for a volume of 1,000 units. So the contribution margin per unit is 8,000 divided by 1,000 units, or $8 per unit. The contribution margin ratio per unit, we want to calculate what is the percentage of contribution to total sales. So the contribution margin ratio is the contribution margin divided by sales. And we can do that per unit or for the total. The percent will come out the same. So that equals 40%. Number 3 says, what is the variable expense ratio? This ratio is variable expenses divided by sales. So we should be able to guess what that is just by looking at the contribution margin ratio, because the difference between the contribution margin and sales is variable expenses. So when we do this calculation, it should equal 60% to add up to 100%. So variable expenses divided by sales, 60%. So this means that every dollar of sales, 40 cents goes to covering fixed costs and 60 cents covers variable expenses. Number 4 says, if sales increase to 1,001 units, what would be the increase in net operating income? The increase in net operating income is the contribution margin per unit times the increase in unit sales. So it would be $8 times 1, or $8. So for every increase in 1 unit of sales, we add $8 to the net operating income. If our sales decline to 900 units from 1,000 units, what would our operating income be? So we can look at, this is 1,000 units. If we want to see what 900 units is, we need to know the per unit cost. Well, 20,000 divided by 1,000 is 20. So we would have 900 times 20. Formatting. Our variable expenses, 12,000 divided by 1,000 is $12 per unit. So 900 times $12 per unit. Contribution margin is sales minus variable expenses. Our fixed expenses don't change. So our operating income would be $1,200 if sales dropped to 900 units. So the new operating income, messes up my math. The new operating income is $1,200. Okay. 6 asks, what if the selling price increases by $2 per unit and the sales volume decreases by 100 units? What would be the net operating income? So now we're looking at 900 units, but instead of our sales price being $20 per unit, so 900 units, sales price increase $2. Our sales then is 900 times 22. Our original sales price was $20 per unit. Now it's $22 per unit. Our variable expenses will not change. Okay, so it's still 900 units. We didn't increase the price of our variable units, so that doesn't change. Now our contribution margin is $9,000 or $10 per unit because we increased our sales price by $2. Fixed costs stay the same. So increasing our sales price, even if our sales goes down, our operating income is going to increase. Number 7 says if the variable cost per unit increases by $1, spending on advertising increases by $1,500, and unit sales increases by 250 units, what would be the net operating income? Okay, that's a lot of steps. So now we have 1,250 units. Variable costs up $1 and fixed costs up $1,500. So we're going to increase our variable costs by $1, spending on advertising, that increases our fixed cost by $1,500, and our unit sales are going up to 1,250 units. So we're back to our original sales price of $20 per unit. So 1,250 units times $20 per unit. Our variable cost has gone from $12 a unit to $13 a unit. So our variable costs are 1,250 units times $13 per unit. Our contribution margin is sales minus variable costs. Our fixed expenses have increased. We increased our advertising expense. So our fixed costs were $6,000 and we're adding $1,500 in advertising costs. Now our operating income is $1,250. So our operating income actually decreases. So even though we sell a lot more units, because we increased costs, our total operating income is going to decrease. This CVP analysis, when we're looking at these things, can also be called what if analysis, because we're answering questions, what if we do this? Or what if this happens? Okay. Question 9 says, what is the break even in unit sales? So the break even amount is total fixed expenses divided by the contribution margin. So remember that it's total fixed expenses divided by contribution margin per unit. So our total fixed expenses are $6,000 and our contribution margin per unit is $8. We calculated that in part 1. So our break-even point in units is 750 units. At 750 units, we have net operating income of 0. The break-even point in sales dollars is total fixed expenses divided by the contribution margin ratio. Our total fixed expenses are 6,000 and our contribution margin ratio as calculated in number 2 is 40%. So our break-even point in dollar sales is 15,000. We have to do 15,000 in sales in order to have a net operating income of 0. Number 10 says, how many units must be sold to achieve a target profit of $5,000? For that calculation, we add 5,000 to our total fixed expenses. Let me type this correctly. So in that calculation, we have our fixed expenses of 6,000 plus a target operating income of 5,000 divided by our contribution margin ratio of 40% gives us the amount in sales. So we need $27,500 in sales. For the number of units, we are going to take our 5,000 target income plus 6,000 in fixed costs and divide that by our contribution margin per unit. So our break even, or the number of units that we need to sell to achieve a target profit of $5,000 is 1,375 units. Number 11 says, what is the margin of safety in dollars and what is our margin of safety percentage? Our margin of safety is the difference between our current sales and our break-even sales. So it's how far our sales could drop before we start experiencing a loss. So our current sales is $20,000. And we calculated our break-even in sales to be $15,000. So for margin of safety, we take our current sales, 20,000, minus our break-even amount in sales of 15,000, and our margin of safety in dollars is $5,000. The margin of safety percentage is our margin of safety in dollars divided by our current sales. So we would take our margin of safety divided by our sales of 20,000 and our current margin of safety percentage is 25%. Number 12 asks, what is the degree of operating leverage? So operating leverage is the contribution margin divided by net operating income. So we take our contribution margin of 8,000 divided by our operating income of 2,000. That gives us our degree of operating leverage of 4.0. Using that degree of operating leverage, what is the estimated percent increase in net operating income that would result from a 5% increase in unit sales? So in order to calculate that, we take our operating leverage times the percent increase in sales to get the percent increase in operating income. So we would take operating leverage times 5%, and that tells us that we would see a 20% increase in sales if, or 20% increase in net operating income if we saw a 5% increase in sales. Number 14 says, assume that the amounts of the company's total variable expenses and total fixed expenses were reversed. So in other words, if our variable expenses were 6,000 and the total fixed expenses were 12,000, then what is the degree of operating leverage? So let's look at that. Let's flip variable and fixed costs. So we're going to have 20,000 in sales still. But now our variable expenses are going to be 6,000, which makes our contribution margin 14,000. Our fixed expenses are going to be 12,000. And our net operating income remains the same. So now to get our degree of operating leverage, we take 14,000 divided by 2,000. Contribution margin divided by our net operating income. That takes our degree of operating leverage to 7. Now we can estimate, so if we take 7% times, or 7 times 0.5% for our increase in sales, we can say that a 5% increase in sales would create a 35% increase in operating income. That is all the calculations that we learn in Chapter 5 created on one example.